Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about TRI Pointe HOMES INC quarterly report. TRI Pointe Homes Inc. offers a range of businesses and services including home design and construction, sale of single-family attached and detached homes, financial services such as plus mortgage financing, plus title and escrow services, plus property and casualty insurance agency services, sales representation through its own sales team, and independent real estate brokers. TRI Pointe Homes Inc.'s stock has experienced a significant decline in the past year, dropping over 20% due to several key factors. The company's weak fourth-quarter results, attributed to elevated mortgage rates, led to an 8.8% drop in stock value. This was followed by declining second-quarter results and a weaker outlook, with home sales revenue decreasing by 22% and net income nearly halving. Forward-looking indicators also showed a 31.5% drop in new home orders and a 41% year-over-year plummet in the company's backlog. The continued decline in demand and expectations for lower future sales further contributed to the stock price drop. Analyst projections of an 18.5% revenue decline over the next 12 months added to the negative sentiment. Although the third-quarter results beat analyst expectations, they still showed significant year-over-year declines in several key areas, including home sales revenue and net income. The combination of these factors has led to a stock price drop of approximately 29.4% below its 52-week high, with a closing price of $32.12 as of October 15, 2025. The outlook for the homebuilding market remains uncertain, contributing to TRI Pointe Homes' declining stock value. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, key contributors include a surge in home sales revenue in the West region, land and lot sales revenue growth, increased financial services revenue, net sales growth, and equity in income from unconsolidated entities. Conversely, revenue decline is driven by decreased home sales revenue in the Central and East regions, lower home deliveries due to warranty reserves, a decrease in new homes delivered, reduced average sales prices, and lower backlog entering the current year period. These factors highlight the regional disparities and operational challenges affecting the company's revenue performance. Net income for the company decreased significantly from $328,757,000 in 2024 to $180,837,000 in YTD 2025, representing a decline of 45%. This reduction is attributed to softer demand conditions and elongated sales cycles in the West segment, elevated inventory levels and market stabilization in the Central segment, and lower beginning backlog and softer market conditions in the East segment. Profit margins also experienced a decrease. The homebuilding gross margin percentage dropped from 23.3% in 2024 to 21.7% in 2025, while the adjusted homebuilding gross margin percentage decreased from 26.8% to 25.7%. This decline is partly due to an increase in total SG and an expense as a percentage of home sales revenue, rising from 11% to 13.1%. The company's debt-to-capital ratio also increased from 21.6% to 25.1%, resulting from higher total homebuilding debt and lower stockholders' equity. The decrease in cash provided by receivables and the increase in cash used related to real estate inventories further contributed to these changes. Overall, the decline in net income and profit margins can be attributed to a combination of market conditions, inventory levels, and financial management decisions. The company's financial performance reveals a concerning trend. Despite its efforts, the business is struggling to generate positive operating cash flow. The net cash used in operating activities for 2025 stands at -$59,561, signifying a significant outflow of funds from operations. This negative operating cash flow indicates that the company is not generating sufficient revenue to cover its expenses, posing a risk to its financial stability and future growth prospects. The company's debt level and interest expenses have undergone significant changes over the past year. In terms of debt level, total debt has increased by 15% from $1,021,602 to $1,177,843. However, this increase is largely driven by a 69% rise in loans payable, while senior notes remain relatively stable. Conversely, mortgage repurchase facilities have decreased by 32%. These mixed signals suggest that the company's debt profile has become more complex. Regarding interest expenses, there appears to be conflicting information. According to one source, interest expenses decreased by $5.3 million, 21%, from $25.3 million in 2024 to $20 million in 2025. However, another source indicates a larger decrease of $30.2 million from $91.8 million to $61.6 million. To reconcile this discrepancy, further analysis is required. Overall, while the company's debt level has increased, the interest expenses have decreased according to one source, but with conflicting information regarding the magnitude of the decrease. The company's financial performance varied across different segments and regions in the past year. Notably, the West segment experienced a decline in revenue by $199 million and a decrease in income before taxes by $41 million from 2024 to 2025. In contrast, the Central and East segments demonstrated relatively stable performance, with no significant changes in their financial metrics during the same period. Management's outlook: a focus on expansion and adaptation, the company's management team is optimistic about the future, despite current challenges in the industry. They are expanding into new markets, specifically the coastal Carolinas region, while also investing in existing markets to drive growth. To manage risks associated with real estate inventory and investments, they have option agreements to purchase land and lots, allowing them to adjust their strategy as needed. To adapt to market conditions, management is adjusting pricing strategies, sales pace, and using incentives to support absorption while protecting returns. They are prioritizing preserving price to maintain long-term brand positioning and margin stability. Additionally, the company is focused on managing its leverage and maintaining liquidity to support operations. Overall, management's strategy is centered around expansion, adaptation, and risk management, with a focus on driving growth while protecting returns and maintaining financial stability. The company's financial summary reveals that it has engaged in share buybacks as part of its stock repurchase program, purchasing a total of at least 15,467,686 shares for $352.8 million. However, there is no mention of dividend payments, indicating that the company has not distributed dividends to its shareholders. Concerns about inventory buildup and supply chain disruption are evident in the financial summary. Inventory levels have increased significantly, with real estate inventories rising by $229,118 from December 31, 2024 to September 30, 2025. This has led to impairments of $8.3 million and $19.3 million for the 3 and 9 months ended September 30, 2025. Elevated inventory levels have also moderated demand in both resale and new home markets in Texas. Furthermore, supply chain disruptions are a concern due to fluctuations in prices and availability of inputs such as raw materials, labor, and home components. The backlog units were down 44% due to sustained softer demand environment and prioritization of price over pace. This has resulted in a decrease in new homes delivered across all segments, with the West experiencing a decline of 32%, Central by 13%, and East by 18%. These concerns highlight potential risks for the company's operations and financial performance. That concludes the financial summary for TRI Pointe HOMES INC. Feel free to comment below, and I will be happy to answer them when possible.